Unity Software came out with their earnings last night, and based on the market's reaction, it doesn't like what it had to see. Now, I sold most of my shares of this company a few months ago, but I still own a small slice because Brian Feroldi and I own some of it in our portfolio over on Common Stock. So let's review how the company did over the next 10 minutes. Again, we're going to be going over Unity, and I want to make sure that we give a shout out to Common Stock for sponsoring today's video. If you head on over to Common Stock, you can go right to my profile by hitting the link in the show notes below, and you can see my portfolio right here. Now, we haven't added every single company because we haven't had permission to yet for our work for the Motley Fool, but you can see if you scroll down that right here, Unity is a stock that's up about 3% since we bought it, and we bought it all the way back in May of 2022. So if you just keep scrolling down, you'll eventually get to that May purchase of Unity. You can click on it here and you can read more about why we chose it there. But let's move on to the current quarter. This was for the quarter that ended December 31st, the fourth quarter, and after today's drop, it'll be about a $14 billion company. Now, on the top line, things appear pretty good. Revenue up 43%, that beat Wall Street's estimates and the company's own guidance. We didn't really get any non-GAAP earnings per share figures, which is what Wall Street was estimating for. Instead, management guided for between $5 and $15 million in operating income, non-GAAP operating income, and the company hit that target, coming with $13 million in non-GAAP operating income. But let's move on to margins. There's a lot of red here. Gross margins were down slightly, but they're still pretty good on a non-GAAP basis, and operating margins on a non-GAAP basis went from a loss to a gain of 2.9%. That's pretty good. Now, we didn't get any non-GAAP net margins, so we have to use GAAP, and there you can see the losses are huge. We'll get to why that's the case in a minute. Free cash flow is still an outflow for the company, while net income losses increased during the year. That's on a GAAP basis, and overall this balance sheet is upside down with $2.7 billion in debt, about $1.6 billion in cash. A big reason for that is the company did a major share repurchase during the quarter, so that's worth keeping in mind as well. Of course, the big story over the past year has been Unity's merger with ironSource, and this quarter includes ironSource. Now, I'm going to take it off this screen for just a second because I just want to point out that one thing that was very frustrating is there was a shareholder newsletter, there was a press release, there was also the conference call, which was really just questions, is that there was no commentary on what growth would have been without ironSource. ironSource, the merger was completed on November 7th, so about 2/3 of the quarter included ironSource. 43% growth looks great, but how much of that growth was because of ironSource and how much was organic in nature, we don't know. Because as best I could tell, I could not find it in any of the materials, which was very frustrating. My guess is that it would have been in the ballpark of just 10% growth, which put things more in perspective of where we are and speaks to some of my frustrations with why I sold the stock. But continuing on, the company has two sections, Create and what used to be known as Operate. Now, Create, they did a little bit of shuffling when the company acquired ironSource. So some of the divisions that were in one are now in the other. The important thing to know here is that Create grew 42% as it used to be recognized, 34% as it is recognized now. That is where designers, that is where engineers can go in and create immersive 3D reality, and they can build games, and other industries outside of gaming are starting to use this as well. In fact, management had a comment on that. Create Solutions up 41%. They said that games, that's their primary customer, was up 24% using Create. This is a subscription-based tool, but this is a big deal that industries beyond games was up 118% year over year. That's things like movies, but it can also be construction. Management spent a ton of time on the conference call talking about digital twins. That's where you create a 3D reality of something that exists in the real world, and you can tinker on tinker on it in the digital reality before actually going ahead and making changes in the real world. They said Create Solutions would have grown by about 38% year over year if not for their Weta acquisition last year. Now, let's move on to the other section, which is now known as Grow. It used to be known as Operate because that's where game designers would create their games in Create, and then they would be able to monetize it and have people play them in Operate. It's now known as Grow after the ironSource acquisition, and that grew under its current reporting structure 51% during the quarter, which was hugely accelerated, as you can see, by ironSource, because it was actually down 15% in each the second and the third quarter. So ironSource is clearly adding to the grow side more than anything else. Now, the company also released these metrics. These blue lines are the number of customers paying the company $100,000 per year. And this yellow line is the dollar-based net expansion rate. That's really important. It tells you, are we holding on to our customers? That would be 100%. And are they spending more with us every year? That would be above 100%. This used to hang out in the category of 140% during the pandemic, but it came down. It hit 111% last quarter, and then it ticked up. And we saw the same thing with the customers right here. It ticked up. That looks like good news, right? Well, it's not the whole story. ironSource was the reason for that. Without that, this would have actually gone to 1,056 customers with revenue above 100,000. So they would have lost about 19 customers sequentially. That doesn't mean that they lost those customers. It means that those customers might have been above the threshold and then they fell below it. But look at this, the net dollar-based net expansion rate would have actually continued its fall down to 109%. So ironSource, again, playing an outsized role right there. I want to also call this out if you look at the cash flow statement, and this is just for the 3 months that ended here. Stock-based compensation is huge. Before the ironSource deal, there was $98 million in stock-based compensation. That was 31% of revenue. After the ironSource deal, of which stock-based compensation is likely to play a role, that up to $174 million, that is roughly 40% of revenue in stock-based compensation. I'm usually someone who is willing to give a pass on that, but that's because the companies are executing on their vision. That I don't think is really the case here, and it's worth pointing out that if we look at overall diluted shares outstanding, we see this going from 345 million shares back in the first quarter of 2022, and it is going to increase by the end of 2023, their estimate, by 43% to almost 500,000 shares, and that was with a major share buyback during the quarter. So shareholders are definitely getting diluted right now at this point. Now, one other thing I just want to take the screen off and talk about real quick is one surprising thing in the conference call was management says that it believes that its Create business can be as big as its Grow business, and Grow is definitely the lion's share of the revenue at this point. It's a little bit surprising because there's two factors at play. One could be, well, is Grow not going to grow as much as they say it is? That could be part of it because it's the ad spending market that plays a huge role in this in-game ad spending market. And if that doesn't grow as much as expected, it makes you start to wonder if that ironSource deal was as worthy as they paid for it. On the other hand, it could be because the Create revenue goes up by a lot, and the company did, again, spend a lot of time talking about how industries outside of gaming are using this, and as they're using it, that Create revenue could start to grow quite a bit as well. One other thing of note is that management throughout the call repeatedly said that the ad market for in-game advertising buys was stable during 2022, but they were forecasting that it would not recover in 2023. So with that as the backdrop, let's just move on and we can just look at the company's income statement. We see that revenue is up 43%. That's great, but almost the lion's share of that is via acquisition. This is a problem. The cost of revenue is up 90%. Some of that has to do with the weakness in the ad market, but some of it has to do with the acquisition. When you get those factors, you get revenue growth of 43%, but gross profit's going to grow much slower at 29%. But then look at this. Operating expenses were up 51%. This is on a GAAP basis, so it includes a lot of stock-based compensation, which means that your losses expanded almost 90% on a GAAP basis. When we turn to guidance, this is probably the main reason that shares are down. Management guided for about 48% growth year over year in the current quarter. Wall Street was hoping for 64% growth. And then management doesn't give earnings per share guidance. They did say that adjusted EBITDA, which is a nefarious metric, one that I'm not a huge fan of, but they said that it should be positive between 7 and 12 million for the full year. It's also worth pointing out that management is guiding for about 53% growth, but Wall Street was hoping for 60% growth. The company is expected to have between $230 and $300 million in positive EBITDA, adjusted EBITDA, which takes out stock-based compensation and restructuring charges by the end of the year. So what should investors watch moving forward? Well, that dollar-based net expansion rate went down to 109%. Keep an eye on that. Second, keep an eye on Create X Gaming. They have called out digital twins especially, and listen in for that. They're really excited about Create. Number 3, free cash flow was negative during the quarter. We need to see this consistently become positive, especially with that upside down balance sheet. And number 4, keep an eye on dilution, because the dilution has been, even for me, who's usually very, very, very lenient when it comes to it, alarming. Overall, we'll say the moat direction is stable. It's hard to tell. Again, management reliability is really called into question. The big thing here for me is just the fact that they are not being clear at all about what their growth looks like without all these acquisitions. There's been Weta, there's been ironSource, and when you don't call those things out, you lose my faith. And so that is still a reason why I sold my shares in my personal portfolio. We're keeping them in the common stock one because we said that that's what we were going to do with this portfolio. Overall, it scores in that robust category for me. Not great. This company is definitely in that hyper growth mode right now, so there's not a ton of areas of the income statement that it's optimized for. But if we look to, say, price to sales and gross profit, we can get something of a valuation metric. On a price to sales ratio, it's trading for between 8 and 9 times sales, depends on what happens when the market opens. It's actually going to go down with ironSource, though, because that adds more sales. Gross profits clocking in about $950 million right now. If you take the market cap of about $14 billion, that gives it a price to gross profit ratio of 15, which is pricey. And so that's where the company is right now. Let us know what you think about this by then clicking on over here and heading on over to Common Stock. If you click on the link below, I'm going to go ahead and just throw these notes in. And if you make a click here and make a comment, we will give a prize, or Common Stock will give $100 to the most insightful comment that someone puts up. I want to give a shout out right now to Steve Matt, who made the most insightful comment on our decision to purchase shares of Mercado Libre, talked about the dilution rate of the company over the years. And so that is where I find unity. This wasn't a terrible quarter. There's definitely some positive momentum here when you talk about areas outside of gaming using Create. That's the big one. And then management at least saying that they believe they're taking the stance that the ad market won't turn around. I think that that's probably prudent. But overall, I am not rushing back to buy shares of this company. I don't miss my frustration with management not being forthright in growth rates when you include all of the acquisitions that have been happening. So this will be one that I continue to watch, and I'll check back in 90 days. Was this helpful? Head on over to Common Stock, leave a comment on these notes, and let us know if you have the most insightful comment. You could win $100. Check back in on this one in 3 months. Brian, out.